Basically, my name is Stanley Mabena, and I've studied at Wits University, and then I've qualified as a chartered accountant, and I'm currently also a registered auditor. So today I'm going to be presenting two topics, being the deferred tax, IS-12, and also property, plant, and equipment, which is IS-16. So these are the topics that we're going to be covering today in a nutshell. I just want to take you through, guys, my notes, because I think the summary notes will help a lot when it comes to us discussing these topics. And then what I will do, I think next week, because I've noted next week we have investment property, which is a short topic. But what I will request that Tekafiso to do, or maybe also the student, is to tell me exactly what question can you do, because we also need to go through questions so that the students can be able to gain more understanding. First is the theory, but after the theory, I want to next week basically start with doing the questions also, so that the students can see exactly what we've been talking about during today. So IS-12 basically it's a deferred tax. Deferred tax is basically the future tax. The future tax, meaning that an entity or any organization, when it calculates deferred tax, it calculates what is going to pay in future for the tax, for the revenue that they're generating, and also for the deductions that they will be getting from SARS. So I'll take you through the steps that we're going to be covering for you to be able to understand what is deferred tax. Step number one, a student need to be able to establish an accounting base. Basically, what is an accounting base? Just a basic knowledge for the student to understand is it's a carrying amount. And what is a carrying amount? A carrying amount is the cost of an asset, meaning that when you buy an asset initially, you will pay for that asset. Then they will give an invoice. The invoice will normally show the cost. So that is that amount, the cost. I will make a typical example. Let's say, for example, you buy an asset for 1,000. So you pay 1,000, they invoice you for 4,000. So that 1,000 is actually a cost. So a carrying amount will be that cost, and then minus the depreciation. The depreciation we'll discuss in detail under PPE, but normally you minus accumulated depreciation, sorry, to get to the carrying amount. So you need to know what is this an accounting base, meaning that in a nutshell, it's just a carrying amount, as I've explained. So that's the first thing you need to know. That's the first step when you calculate deferred tax. The second step that you need to take into account is the tax base. The tax base is actually a tax term, it's not an accounting term. A tax base, basically they classify it in as far as assets are concerned, and then also in as far as liabilities are concerned. So meaning that you need to know both definitions for assets and liabilities, because for you to be able to calculate deferred tax, you need to know what is your carrying amount or your accounting base, and then also you need to know what is the tax base of that asset or a liability. So to make a typical example, first before I do that, let me just read you a tax base of an asset. What is basically a definition of a tax base of an asset? I've done a summary note here, but I'll just read it for you. A tax base of an asset, they define it in IS-12 as the amount that will be deductible for tax purposes against any taxable economic benefits that will flow to an entity when it recovers the carrying amount of the asset. If those economic benefits will not be taxable, the tax base of the asset is equal to its carrying amount. So let me just try and Solomon, can you be able to see my screen?
Yes, I can see your screen.
Yeah, so basically, now do you follow? We are currently talking about the tax base, right? So
yes.
what is very important for you to understand, right? I've explained first what is a carrying amount, and probably you know what is a carrying amount, right? So now, for you to be able to calculate deferred tax, you need to know also what is called the tax base of both the asset and the liability, right? So I would like to make an example, because this is just a foreign language for you when I read it first time. But I want to make an example so that you can be able to understand exactly what this definition means. But also let me just go take you through it again. The amount that will be deductible for tax purposes, right, against any taxable economic benefits, that will flow to an entity when it recovers the carrying amount of the asset. If those economic benefits will not be taxable, the tax base of the asset is equal to its carrying amount. So Solomon, in a nutshell, a tax base is actually allowances that you get from SARS. But what I want to highlight to you is these taxable economic benefits, right? Have you gone through the definition of an asset?
Oh, yes.
Yeah, let's just go, let's just break it down, because I want to explain this concept of economic benefits, because it's very important. A definition of an asset is a resource. You'll agree with me. Is a resource controlled by an entity, right? Controlled by an entity, right? As a result of past event, right? If you go through the IS1 definition, you'll get this definition from there, as a result of past event, from which future economic benefits, future economic benefits will flow to the entity, right? All right. So the reason why I want to take you through this definition is because I want you to understand this concept of economic benefits. What do they mean by that? So to make a typical example, you remember that example that I've made earlier to say that you bought an asset for 1,000. Solomon, are you still there?
Yes, I'm still there.
So you bought an asset for 1,000, right? How much did you pay? You pay 1,000, so they give an invoice for 1,000. So now the intention for you, let's just call this asset a plant, and the intention for you to buy this plant is you want to produce milk, right? You want to produce milk, and that milk you want to sell it either to Pick n Pay, or you want to sell it to any other store out there, right? So Solomon, what do they mean by these? First of all, a resource controlled by an entity. Obviously, when you buy an asset, you will control it, because you will direct as to how it's being used. Am I right? You agree with me, right? So you control, because you've signed the contract and everything. So you are in control of that asset, right? Even the you take the risk, because you're the one who's going to be responsible for anything that happens to the asset, right? As a result of past event, the past event would have been when you have decided to buy the asset, right? On that day when you have decided, due to the need, you have decided to buy an asset, that would be that past event. Now, they are saying from future economic benefits will flow to the entity. What are those future economic benefits? Because that's very important. So I said to you, you bought a plant, you want to produce milk, right? So the milk that you're gonna produce, you're gonna sell, maybe pay, I don't know how you measure milk per gram or whatever. You're gonna sell each of it that you produce. Let's say you're gonna produce 10, and then you're gonna sell it at 2 rand, right? So you're producing 10 milk using this plant, right? And then you selling it at 2 rand at Pick n Pay. Obviously, they will add a markup and sell it to me as a final consumer. So this 20 rand, Solomon, it's actually future economic benefits. You agree with me? Because this is how much you're gonna generate from using this plant in producing the milk. You understand, ne?
Yeah.
So this definition, basically, it means that. So in a nutshell, this 1,000 that you bought the plant at, it's basically the revenue, the future revenue you're going to generate from using this plant, right? If let's say you depreciate this plant for, I don't know for how many years. I just want to check something here quickly. Just bear with me. Ne? There's a reason why I'm taking you through this thing. Ne? Let's say you're going to depreciate this plant for 50 years. Ne? So it means over the 50-year period, ne, you're going to generate revenue of 20 Rand per year. So over the 50-year period, you're going to generate revenue of 1,000 using this plant. You understand what I'm saying?
Yes, yes.
In a nutshell, this carrying amount actually, Solomon, is revenue that you are going to make using this plant. Because a lot of people don't understand that part. That is why I'm taking you through this. And there's you'll see when I make an example, when you calculate deferred tax, what exactly I mean. I'm going to take you back to this example. So do you understand by this definition here, when they say future economic benefits? Ne?
Yes.
Yeah, so basically that's what they mean. So let's read it again. It says the amount that will be deductible for tax purposes against any taxable economic benefit. Taxable economic benefits is actually the revenue you're going to be generating from using that plant. But let's go back to our example. So now, SARS knows that using this plant, you're going to generate revenue for 50 years of 1,000. So now SARS is going to give you allowances. Ne? Going to give you allowances for using this plant. And SARS is going to say, I'm going to give you deduction for using this plant of 1,000 over the 50-year period. No. Maybe SARS will say over the 20-year period. Ne? So over the 20-year period, it means every year SARS will give you, let's see, will give you a deduction every year. Ne? SARS will give you a deduction of 50 Rand. Ne? You are generating revenue, but I don't want my revenue. Okay, it's fine. We'll sort that one out when we do the example. So every year SARS is going to give you 50 Rand worth of a deduction ne? When you use this plant. You remember those Section 20 allowances and Section Mang allowances, ne? So every year when you use this plant, SARS is giving you a tax benefit where instead of you paying a higher revenue tax, you're gonna get a deduction of 50 Rand, right, from SARS. So basically, that's what they mean by this definition of tax base of an asset. So it's the future deduction that you're gonna get from SARS when you're using this plant. Ne? And then they make an example. I've made an example here. I said the tax base of an asset, a company purchased an item of property, plant, and equipment for 1,000. Over the life of the asset, deduction of 1,000 will be available in calculating taxable profit through capital allowances. All deductions will be available against trading income, and no deductions will be available on sale. Management intend to use the asset as deduction of 1,000 will be available over the life of the asset. The tax base of an asset is 1,000. So also what you need to check here, Solomon, is how you recover an asset. Ne? If it's, in this case, this example that I've done for you here, you are recovering the asset ne? Through use. Ne? Sometimes you recover an asset through a sale transaction. Ne? In that case, let's say you buy land with an intention of selling it. In that case, you are not recovering that asset through use. You are recovering it through sale. But you'll see, I'll take you through also the examples when we go through it. For now, it's just for me to explain these definitions for you so that you have an understanding. Ne? And then let's look at the tax base now of a liability. Ne? Let's read the definition. And I've done some summary notes here so that you can refer to IS 12. Ne? IS 12 paragraph 8. That's where you get these definitions from. Ne? And then the same with asset, IS 12 paragraph 7, right? That's where you get all these definitions. And Solomon, is very important for you to understand deferred tax. Ne? It's very important for you to understand these definitions. Because if you don't understand these definitions, you'll never get deferred tax calculation correct. You understand? So let's go through to the tax base of a liability. Ne? So they are saying a tax base of a liability, as defined, is its carrying amount, right? Its carrying amount, meaning, what do they mean? They mean the carrying amount of a liability, ne? Less, meaning minus any amount that will be deductible for tax purposes in respect of that liability in future periods. Ne? I'm sure you're familiar with the concept that SARS uses. Ne? For example, if they say, if you incur an expense, we'll give you deduction for that expense when you actually pay for that expense. You remember that that thing, ne? From SARS perspective.
Yes.
So meaning that, I'll make an example now, ne? But let's read the definition. Ne? They are saying it's a carrying amount of that liability, less any amount that will be deductible for tax purposes in respect of that liability in future periods. In the case of revenue which is received in advance, the tax base of the resulting liability, it's its carrying amount less any amount of the revenue that will not be taxable in the future period. So in this case, there's two types of examples that I need to make for you. Number one is for the ordinary liability, and the second one is for actually the revenue received in advance, right? So you need to understand both these tax bases, right? So now let's make an example. Ne? Let's say we have in our balance sheet, we have a provision for landfill site. Ne? Landfill site. You know what is a landfill site, ne? Or do you want me to make an example?
Isn't it when after the mines finish using the land and they have to repair it?
Yeah, 100%. You understand it 100%. Guys, let me know if there's another guest we are just joining, so that I accommodate everyone. So basically, provision for landfill site, it's a liability, right? So let's say at year end in our balance sheet, we are sitting with a liability of how much? Let's say of $1 million.
Okay.
Meaning that, what does this mean, Simon? It means that we have a present obligation, right, to settle this obligation after, let's say, 20 years from now, because we need to rehabilitate the land, as you have explained. We've polluted the land through that mine dams and everything, but after 20 years from now, we have a present obligation to actually rehabilitate the area where that landfill site is, so that everything is neat and clear. Right, so we were actually then raised that liability of 1 million. But there's one thing: SARS doesn't give you deduction immediately when you incur the liability, right? When are they going to give you deduction for this expense that you are going to incur in future? They're going to give you deduction when you actually incur it, meaning when? After 20 years from now. Do you agree with me?
Yes.
Because this is how SARS works, isn't it? So now let's go back to the definition. Let's read it and make sure we understand it. It says the carrying amount less any amount. So now let's go back there. Where is our carrying amount? Our carrying amount is this 1 million. You agree with me?
Yes.
In period one. Period one, we have this 1 million rand. So it says it's the carrying amount. Let's go back again. So here's the carrying amount. Is this carrying amount 1 million less? Let's do that. Less any amount that will be deductible for tax purposes in respect of that liability in future period. So meaning that in respect of that liability being the provision for landfill site, am I right? For future period. So what did I say to you now? I said SARS will only give you deduction when you actually pay the expense, right? So what is let's read this definition. It's carrying amount less any amount that will be deductible for tax purposes in respect of that liability in future period. So which amount is deductible in the future period when you're looking at this liability?
In 20 years' time, the 1 million is deductible.
100%, I agree with you. Thanks actually for that feedback, because a lot of people get this thing wrong. So it's the same carrying amount. Ne? Because when you read, it says it's carrying amount less any amount that will be deductible for tax purposes in respect of that liability in future periods. So is this carrying amount less any amount that SARS will give you as a deduction when you incur that liability, which is the same carrying amount, because SARS won't give you a deduction now, but he will give you a deduction in 20 years period time, right? When you actually incur the liability, right? So now, what are the results? So they are saying the tax base of that liability. So the results here, once you have done this calculation, the results here, it will give you the tax base. So now when you calculate, when you say that minus that, you're getting 0, you see? Have you calculated deferred tax before, ne?
Yes, yes.
Have you wondered why always with your liabilities, your tax base is 0? Have you asked yourself that question?
The tax base, wouldn't the tax base be?
Remember when you calculate the deferred tax, ne? You take carrying amount, am I right? You minus tax base, you get the temporary differences, ne?
Yes, yes.
Have you wondered always with liabilities, why is your tax base 0? You have seen that situation, am I right?
Yes, yes.
It comes from here, Solomon. You see that? You see our tax base is 0.
Yes, yes.
So basically, this definition here.
Can I ask a question?
Yes, definitely can.
Yes, okay. Just with this right now.
Yeah.
So we're saying in the next 20 years, meaning that in the current year, we don't deduct anything, right?
Yes, there's no deduction. There's nothing.
So meaning that our deferred tax will be an asset.
No, it won't be. Yes, you're 100%. Because now, why you're saying is an asset? Because when you take the carrying amount minus the tax base, your tax base being 0, you agree with me?
Yes.
Getting a temporary difference of how much? Of $1 million. Am I right?
Yes.
But that temporary difference of $1 million, it's in a form of a tax saving. You see? Because in future, when SARS start giving you a deduction, what will happen? You will save in terms of tax because you're going to pay less tax. You see? But you see when I make an example. For now, I'm just explaining. I'm still going to make an example for you so that you understand what I'm saying. Ne? So we take the carrying amount of the liability, which is $1 million. We minus the tax base, which is 0. We're getting a temporary difference of $1 million. Ne? Then from that temporary difference of $1 million, which is in the form of a tax saving, because these are the deductions we're going to get in the future period when we actually then start incurring the expense. So we are saving when it comes to tax. That's why it's called a deferred tax asset, because these are future economic benefits that an entity will realize when they start getting deduction. You understand? You see, we're going back to the definition of an asset. Where's that definition of an asset? I did make it. I think I did. You remember that definition of an asset? A resource controlled by an entity, in this case, which is a deferred tax asset, as a result of past event, being the plant that we would have bought, obviously resulting in the deferred tax, from which future economic benefits are going to flow. What are those future economic benefits, in this case, being the deferred tax asset? Is that tax saving, because we're going to pay less tax. You agree with me?
Yes.
Yeah. So just, I don't want to confuse you. For now, based on what I've explained, do you understand the tax base of a liability?
Yes.
Yeah. So what I will do, I'll share these notes with you, ne? Because it will be very important for you to always refer to them in case you have forgotten. Ne? So I've just explained one part of a tax base of a liability. Ne? There's a second one. In this case, most income received in advance. Ne?
Yes.
Let's say we have income received in advance. You'll agree with me when I say it's a liability. Am I right?
Income it's a liability.
Received in advance. Okay. Let's say we've got an income received in advance of 10 million. Ne? Let's go to the definition. It says, in the case of revenue which is received in advance, ne, If a revenue received in advance is income received in advance, how? If let's say your client pays you in advance for the services that you still need to render to them, but you haven't, do you agree with me that you have received money that you still owe your client?
Yes.
Because you haven't yet performed any services or you haven't yet delivered any goods. So they paid you in advance. So should it happen that you don't deliver, you still need to pay them back their money. You agree with me?
Yes.
So it's basically a liability to you because you owe them up until such time that you deliver the service or you deliver the goods, right? So it's a liability. So let's put it in brackets. It's a liability, right? So now let's go to the definition in terms of IS-12. It says, in the case of revenue which is received in advance, the tax base of the resulting liability is its carrying amount. Let's go back there. Is this amount here, right? Which is the carrying amount, 10 million. I mean, sorry, 10,000. You agree with me?
Yes.
Right? It's its carrying amount less any amount of the revenue that will not be taxable in future periods. So now let me explain this part for you, Solomon, because a lot of students get confused. Yeah? So you remember what I said? SARS tax you on area of receipts or accrual. You still remember that, yeah? So in this case, the client had paid us at 10,000. So SARS, what it sees in our books, it sees 10,000. So SARS is going to nail you, it's going to tax you on that 10,000. But is it fair? It's not fair for you because you haven't rendered the service and you haven't earned the money. Am I right?
Yes, yes.
So now let's go back there. So now they say less amount, they are saying less amount of the revenue that will not be taxable. So sorry, let me just copy this because you're going to use these notes as a reference. That if I put this here, and then the same with the liability part there, it says less. One thing I must tell you, Solomon, it's not going to take you one day it's not going to take you one day to understand deferred tax, but based on these notes that I'm preparing for you, you'll see over time, you will understand what is deferred tax, and it will be much easier for you because once you grasp this concept, you can do any question. You're not going to struggle, right, with deferred tax. So let's go through it again. It says, in the case of revenue which is received in advance, the tax base of the resulting liability, its carrying amount, which is 10,000, less amount of the revenue that will not be taxable in future periods. Now let's go back here. If this amount of 10,000 is taxed now, right, is taxed now, let's go to the definition. The tax base of the resulting liability is its carrying amount less any amount of the revenue that will not be taxable in the future period. So which amount will not be taxable in the future period? If this 10,000 is taxed now, will it be taxable in the future period?
It will be taxable in the future period if we do render the service. No.
Okay. Let me just take you through this again. Just apply your mind. I want you to apply your mind.
Okay.
They are saying, in the case of revenue which is received in advance, the tax base,
yes,
which is what is that example that I've just made now, the 10,000, right? We received this money in advance. The tax base of that resulting liability, it's its carrying amount, which is 10,000, right?
Okay.
Less any amount of the revenue that will not be taxable in the future period. So I'm saying to you, Solomon, if this 10,000 is being taxed now, will it be taxed in the future?
If the 10,000 is being taxed now,
remember it's area of receipts or accrual. So we have received the 10,000 now. It will be taxed now.
It will be taxed when it goes to profit and loss statements in the following years.
No. Definitely it's going to be taxed now. You agree with me, right?
Okay.
It's going to be taxed now because, as I'm saying, SARS area of receipts or accrual, Immediately when your money kicks in into your company bank account, SARS takes it. Doesn't matter whether you have earned that money or not, SARS takes it. Ne? So now it says less any amount of revenue that will not be taxable. So the question that I'm asking you is, which amount is not going to be taxable in future?
In future?
Yes. Remember, the 10,000 is being taxed now. Less any amount of revenue that will not be taxable in future. Remember, SARS can't tax you twice, man. I'm saying it's being taxed now. So less any amount of the revenue that will not be taxable in the future period. So of the same revenue, which amount is not going to be taxable in the future period? I've already given you an answer.
There's no amount that won't be taxed in the future period.
100%. So I'm saying to you, the tax base of the resulting liability is its carrying amount less any amount of the revenue. So what I'm saying is that if this amount is being taxed now, less any amount of the revenue that will not be taxable in the future period, right?
Okay.
So the tax base resulting from is the carrying amount less any amount of the revenue that will not be taxable in the future period. So the answer here, Solomon, is actually the 10,000. You understand why I'm saying that?
Okay, yes, I understand, yes.
And 10,000, if it's being taxed now, it means in future it's not going to be taxed.
It's not going to be taxed, yeah.
100%, you agree, ne? So
yes.
Now, when you go to the formula, when I calculate here, we put the same 10,000, because the same 10,000, if it's being taxed now, in future it's not going to be taxed. You understand? So,
yes.
So the tax base then becomes 0. You see?
Oh.
Understand? So the reason why I took you through this example is because even lectures sometimes they don't explain to you how the tax base of a liability came about.
Oh.
They tell you that no, guys, the tax base of this liability is 0. But as to how it came about, they don't tell you. So I'm taking you through this example so that you can read your definition yourself and know exactly how did you come to the tax base of 0 for liabilities. You remember I asked you a question. I said to you, have you wondered why a tax base of a liability is always 0? And then you didn't give me an answer. It's because of this, what we have went through here. This is how it came about. You understand now?
Yes, I understand now, actually.
So I hope this you'll grasp it, because going forward, you know, if not even a single day you're going to struggle with the tax base of a liability. Now you know it's 0, and you know why it's 0. You understand? Ne?
Yes.
So let's move on. Let's see here what I've done. I said the tax base of a revalued asset that is not depreciated, in this case, the land component. Basically, remember the land is not being depreciated. So the tax base will always be the same amount. Ne? So hence, you're not going to calculate deferred tax on the land.
Yes.
Yeah.
Yes.
So now, I've taken you through the tax base of a liability, and I've taken you through the tax base of an asset, right? So I'll send you these notes through permission if Mr. Popolo allows me, ne? And then I'll send you guys these notes, because these notes, I'm not saying you should use these notes for studying, but these notes, more especially when you prepare for exam, you should use them as a reference, ne? Because I've summarized IS12 for you, basically. Ne?
Okay.
So now we just finished step 2. Ne? We are going to step 3. Step 3 says identify and calculate exempt temporary differences, right? So now, a temporary difference in terms of IS12 arises whenever the account base, what is an accounting base? Ne? It's a carrying amount.
Yes,
whenever a carrying amount is an accounting base and the tax base of an asset or liability are different. If these two are the same, you're not going to have a temporary difference. You agree with me?
Yes,
Don't
yes,
worry, Solomon, we're still going to go through the example, which I've done for you. So for now, I'm just taking you through the theory so that you understand when we go through the example. So they are saying a temporary difference arises whenever the accounting base, which is the carrying amount, and the tax liability are different. A temporary difference can be either a taxable or a deductible temporary difference. I'll explain that to you when we do the example. A taxable temporary difference is described in IS 12 paragraph 5 as a temporary difference that will result in taxable amounts in determining taxable profit, tax loss of future periods when the carrying amount of the asset or liability is reversed or settled. You'll see that when we do the example. So this definition is just explaining to you what is a taxable temporary difference. So for example, in that case of an asset, if we have a carrying amount of 100 and a tax base of 80, so when you take the 100 minus the 80, you have 20 rand, which is a temporary difference. So that temporary difference is taxable temporary difference because that's future income, right? You'll see part when I make an example. Similarly, with a deductible temporary difference, as described in IS 12, is a temporary difference that will result in amounts that are deductible in determining taxable profit, tax loss of the future period when the carrying amount of the asset or liability is recovered. In this case, Solomon, it will be the liability, because the liability is a deductible temporary difference because you have a carrying amount of a liability, in this case being 10,000 minus 0 tax base, right? And then you get a deductible temporary difference, you see, for future. Now, a taxable temporary difference, a company, here I'm just making an example. A company A holds an item of property, plant, and equipment, which has a carrying value of 1,000, a tax base of 500 of the at the reporting date. There is a temporary difference of 500. As the carrying amount, as the carrying value of the asset is higher than the deductions that will be available in the future. This is therefore a taxable temporary difference. You understand?
Yes,
because, yeah, based on exactly what I've explained earlier. So now, a deductible temporary difference example, a company contributes to a defined contribution pension scheme. At the year end, company A has a recognized accrual of 5,000, which is a liability. You agree with me?
Yes.
In the country where company A is domiciled, contributions to the scheme are taxed on a cash basis. In this case, it will be those, what do you call, income received in advance and stuff. The tax base of this liability is nil, and there is a temporary difference of 5,000. A tax deduction will be available in the future when these contributions are paid. Remember the area of receipts and accrual, to the scheme. This is a deductible temporary difference. So you understand?
Yes,
so we can move on. I'm not saying I'm trying to move on quickly, but I'm just trying to push so that we can make an example and then also move on to the next topic, which is property, plant, and equipment.
Okay.
But do me a favor, once we are done with this lecture, when you go home, go through these examples and go through these notes. I'm going to send it to you. Go through these notes, and then should you happen that there are some gray areas, next week when we have a lecture again, at least tell me what are those gray areas so that we can go back to them and try and clarify them for me, right? You understand me? Okay. So now let's go to step 4. Step 4 says, identify the relevant tax rate and apply this to calculate deferred tax. This one is very simple, Solomon, because already you know when the commissioner announced to say that the tax rate will change to say it's going to be 27%. I'm guessing for the companies, right? So obviously that one is obvious. You will know that is the tax rate you're going to use, 27% for companies. Am I right? So I'm not going to dwell too much on that because that one is obvious. Calculate the amount of any deferred tax. So for this part, you'll go and read these notes yourself. But what I want to do, I want to take you through You'll go and read these notes yourself, but this one here, I'll clarify this part through the example. So this is step 5. This step 5 I will take you through when we do the example, because it just says calculate the amount of any deferred tax asset that can be recognized. So when you do the example, you see exactly what I will be talking about there. So, and then in step 6, determine whether the offset of the deferred tax assets and liabilities. The offsetting concept will only happen when the deferred tax assets and liabilities are required to be offset only in certain restriction scenarios. Deferred tax assets and liabilities must be recognized gross in the statement of financial position. You know most that they are recognized gross, meaning that in your balance sheet under asset, non-current asset, you have deferred tax asset,
Yes.
and then under non-current liabilities, you have deferred tax liabilities. But unless the entity has a legal or enforceable right to set off current tax assets against any current tax liabilities, then that's when you're going to offset them. The deferred tax assets and the deferred tax liabilities relate to income taxes levied by the same taxation authority on either the same taxable entity or whatever. So these are basically notes that I've prepared, which are coming from IS-12 for your own knowledge. But
Okay.
yeah, we don't have to go through them. It was just for me to do these steps so that you know when you have to think about deferred tax, what exactly you need to do in terms of these steps. You need to know, number one, what is your carrying amount or your accounting base. You need to know what is your tax base. You need to know, you need to then know the temporary differences, and then definitely you calculate the deferred tax, right? And then, now let's move on to the examples that I've done for you. So basically, there's two methods you can use for calculating deferred tax, right? There's a horizontal approach, and you'll see on your or textbook or your notes, and then there's a vertical approach. So the horizontal approach is the one that we are used to, where basically you take the carrying amount, you minus the tax base, and then you minus your temporary differences, and then you get the deferred tax. So initially, you remember that example that I've made for you, Solomon, the one where
Yes.
you got an asset for 1,000, right?
Yes.
Initially, on the first day when you buy an asset, there will be no tax consequences, deferred tax consequences, because both the carrying amount and the tax base are the same. You see? So
yes.
That's what you see here. So initially, when you buy an asset, the carrying amount will be the same as the tax base. So there will be no resulting temporary differences. The temporary differences will result when we have temporary differences. And those arise when your depreciation is different from your allowances. So I made an assumption here. I said depreciation provided is 10% in this plan, right, that we bought. And then when you look at your SARS allowance, it's 20%. You see? So
yes.
if you look at our depreciation, if you apply 10% to the 1 million, you're getting a depreciation of 100. If you apply 20% to the tax base of 1,000, you're getting 200. So now at year end, you have a carrying amount in your balance sheet of 900, and then your tax base from SARS perspective is 800, right? So now you have 100 rand, which is the temporary differences. Then based on that, I've calculated the deferred tax using the 27%. But now, there's an interesting thing that I want to you remember when we went through the definition of an asset. You remember what I said to you?
Yes.
Asset is a resource controlled by an entity, as a result of past events from which future economic benefits, future economic benefits will flow. Remember, I made an example with us buying. Let's just assume that this plant we are using to produce milk, right? Applying the definition, Solomon, this 1,000, you remember what I said? I said is the equivalent of the revenue you are going to generate from using this plant for 50, or in this case for 10 years. So meaning that the carrying amount actually of an asset, it represents the revenue, the equivalent of revenue you're gonna generate over the 10-year period, because you are depreciating the plant for 10 years. Over the 10-year period, which is the revenue of $1 million. You get that part, ne? Solomon, are you still there? Hello? Solomon?
Hello? Yes, I'm still here.
Yeah. No, I'm asking you a question.
Yes, I'm still here.
Yeah. I'm asking you a question. Ne? Can you hear me? Ne?
Oh,
Solomon?
okay. Yes, I can hear you now.
Yes, I'm saying.
Yes, I can hear you now.
Okay, that's fine. I'm asking you a question. I'm saying this property, plant, and equipment we bought for 1,000. Ne? We are depreciating it for 10 years. Ne? I'm saying to you, this 1,000 represent revenue you're gonna generate from using this plant for 10 years. You agree with me?
Yes.
Because every year you're gonna sell, and when you sell the milk, you're gonna generate a revenue of 100 rand every year. So hence I put it in a vertical format, because this is basically revenue of 1,000. Ne? And then every year, obviously, it goes down. Ne? This is year 2. Ne? Now, let's go to the deduction. SARS is going to give you deduction. In the first year, obviously, in year 1, what did I do here? In year 1, this is revenue. Okay, let's go to year 2. Ne? I'm saying the revenue you're going to generate is $1 million. Ne? Sorry, it's 900,000, right? And then SARS is gonna give you a deduction of 20 rand, because every year, if you're generating revenue of 100 rand, SARS is gonna say, no, I'm gonna give you a deduction, boss, of 200. Yeah? So at the end, you need to show to the users that I have a taxable income of 100 rand. You see?
Yes.
Know how to calculate taxable income in terms of tax?
Do I know how to calculate taxable income?
Yeah, because this formula here, I mean, this format is basically when you're calculating taxable income. You see? Because you take revenue minus deduction, you get taxable income. You see?
Yes.
So what are you saying here? You are saying, let me put it in the simplest format. Ne? You are saying to the users, for the next 4 years, because already a year has passed, ne? For the next, no, Simon, I'm confusing you. In the first year, let me just change this. Let me just say this is day 1. Let me just say this is day 1, because this is, I see, is confusing me. Day 1, there's no tax consequences, but in year 2, you are saying to the users, over the next 4 years, I'm going to be generating revenue of 900, ne? Using this plan. You understand, ne?
Yes, I do.
When I generate that revenue, SARS is going to give me deduction that are worth 800. You understand?
Yes.
For the next 4 years. Ne? So users, listen, for the next 4 years, I will be paying tax on the taxable income, because now, if I'm going to generate revenue of 900 and SARS is giving me a tax saving, meaning deduction of 800, the difference I need to pay tax on, which is future profits. And it goes back to the definition of what? Deferred tax. Because deferred tax, you calculate it on future profits. So you are saying to the users, of this revenue of over the next 4 years I'm going to generate, SARS is going to give me a deduction of 800. So it means I must pay to SARS tax on 100 rand. You understand?
Yes.
That tax on 100 rand, we call it a deferred tax, because it's future tax. Do you understand what is deferred tax now, Solomon? Did I simplify it for you?
Yes, you did. Yes.
Yeah, so I think you need these notes, ne? So I'll send you these notes. But yeah, so basically this is what we are saying to the users of the financial statement. So every time you're seeing the financial statements of any entity, when they have a deferred tax, they are basically telling you that they will be paying tax for future revenue they will be generating. And based on that, they need to pay tax of 27 Rand. You see? So now you need to record this in terms of the journals. Ne? Journals, you debit the tax expense and then you credit what? The tax liability, 2727. And that is all. This is basically deferred tax for you. It cannot go complex than this. That is all. So what I've explained to you here is the asset part. Ne? Let's go to the liability part, which is the last one. Ne? I've already actually explained. So you have a provision for landfill site. Ne? So the carrying amount is how much? Is 100,000. Ne?
Yes.
The tax base is how much, Solomon? You must tell me.
0.
It's 0. You understand now, ne? Where
Yes.
it comes, right? And then we have a future, because remember, we're going to get these deductions when? 20 years from now.
In the future.
Yes, in the future. So now, SARS is going to give you a deduction of 1 million. You see? When you actually pay. Meaning that when the contractors start rehabilitating the land, you're paying the laborers for rehabilitating the land, you pay the bulldozers for clearing the land and stuff. You're going to incur a total expense of 100,000. So SARS is going to give you deduction on all those expenses, but not when you start providing for it. But now you must show to the users, to say to the users, when I start rehabilitating this land and I'm going to incur an expense, which is, in this case, I have a liability of 100,000. SARS is going to give me deduction of 100,000 in the future period, 20 years from now. And for that, I'm going to have a tax saving of 27,000, right? And then you can even do it like this, the way I've done it, in a vertical format. In this case, obviously, we don't have a revenue, but we have deduction because we're going to get deduction. And then we're going to have a taxable loss. In this case, it's a loss, it's not income. Ne? So of that loss, you know, a loss will result in a tax saving. Am I right? So hence, you have deferred tax asset because you are saving. And I've explained earlier why is that. I took you through the definition of an asset due to those economic benefits of saving. So here the journal, you have a deferred tax asset, you have a taxation expense. In this case, it's sort of an income. You see? So I'm done with explaining. I'm done with deferred tax. Unless you have any questions that you wanna pose to me, I'm ready to answer any question.
No, I'm fine so far. Yeah, I'm fine so far. Yeah.
You've grasped the concept, right? Because what is important is, remember, Simon, at the end of the day, because I know students most of the time, they rush to do questions. And the mistake they do is for them not to understand the theory behind. Because the lectures will always twist questions around. That's why you end up failing the exam. But what is important is that if you can grasp the concept, you won't be able to struggle. You won't struggle with any question that comes about for deferred tax. You know why? Because you understand the concept. You get my point, ne?
Yes,
so
I do, yes.
That's the main reason why I took you through this exercise. Rather than us going straight to the question, now you start asking questions. What is a tax base? What is this and what is that? But you don't understand. You understand? So now, by next week, and then once you have gone through these notes during the week, you will come back and tell me, Stan, thank you for the example. I actually now understand what is deferred tax. Why are we actually calculating deferred tax? And the concept behind deferred tax. Okay. So now what we're going to be doing, we're going to be covering IS 16, property, plant, and equipment. What I've done for you guys also here, I've done the summary notes so that you can, basically this is a summary of the whole IS 16. Ne? I've summarized it nicely for you so that you can follow in that statement of what is happening. Ne? And I've actually aligned them in terms of the topics that are discussed in that statement. And then you can use these notes to actually study, prepare. Study the IS, you must study the IS 16. Eh? These notes shouldn't be basically what's the word I can use? These notes shouldn't be basically everything for you. You still need to go through IS 16, but this thing should guide you as to what is IS 16 is talking about. You see?
Yes, yes.
Yeah, and then also maybe before the exam, because you don't have time, maybe you can use these notes just to memorize some things before you go and write. But you still need to go through IS 16 and familiarize yourself properly with each and word by word. And then this is how you're gonna master IS 16, right? So now this property, plant and equipment, this IS 16, they basically saying standard IS 16 prescribes the accounting treatment for property, plant and equipment, and therefore it is one of the most important and commonly applied standards, right? So the main topics dealt with in IS 16 are the following. Ne? So now here, what is happening is that this is property, plant and equipment. So all your assets in the entity are dealt with under this umbrella in terms of under this IS 16, except for, like, for example, inventories and all the other assets that are not accommodated in these standards because they have their own standards. Yeah? So under IS 16, what you need to know, Solomon, is that we're discussing these topics. Yeah? The recognition of property, plant and equipment, right? You need to know how property, plant and equipment is recognized. Yeah? The measurement at and after recognition. So you need to know, once you have recognized the property, plant and equipment, how do you measure it subsequently, right? Also, the impairment is talked about in IS 16, but not in detail. It is actually discussed under IS 36, which is, I've realized under the work plan that we're going to discuss it further there. Ne? So don't worry about me not having gone through too much under the impairment under IS 16, because they don't say much, but there is a specific standard for impairment, which is IS 36. Ne? Right. So we're still gonna go through it. I think you'll see in the next lectures that are still coming. We're still gonna discuss on its own IS 36. Derecognition. So in IS 16, basically, Solomon, you need to master, understand these topics, because this is all IS 16 is all about. Yeah? So now let's look at summary notes that I've done for you. So recognition of property, plant and equipment. Yeah? One thing you need to know is that when do you actually be in a position to say that when you buy an asset, you can actually recognize it in your books or in your balance sheet, right? So IS 16 says property, plant and equipment are tangible items that are held for use in the production or supply of services. In the production, you remember that example that I've done for you, where we bought a plant and then we're gonna produce milk. So you can use it, that plant, to produce milk. So hence they are saying in production, supply of goods and services. You can buy yourself a motor vehicle with an intention of using it to deliver goods and services, or you can buy a truck with an intention of using it to deliver goods and services. You see? For rental to others, you can buy trucks, you rent them out to others at the lease fee or something like that. Ne? For administrative purpose. Ne? In this case, you'll have an administrative buildings like your offices. I don't know the company that you're working for, the building where you guys are working in. If that company owns that building, they are using it for administrative purposes, because that's where all decision making are taking place, employees are housed and all that, right? And are expected to be used during more than one period. So meaning that if you buy an asset with an intention of not using it for more than one period, I mean, that's basically not a property, plant and equipment. Already this explanation here is excluding it. So you can't classify that as PPE. Probably if it's not PPE, then what is it? It will be an expense, right? You expense it immediately, right? So now, Also, I-16, what it says that I-16 states that the cost of an item of property, plant, and equipment shall be recognized as an asset if and only if, right? So if we bought that plant of 1,000, we can only recognize that cost only if it is probable that future economic benefits associated with the item will flow to the entity, right? Only if it's probable. So you cannot recognize that cost if it's not probable. In that case, where you have a plant that you are using to produce milk, how can you actually achieve the probability criterion? Let me ask you that question, Solomon. Because the reason why I'm asking this question, I want you to see if you understand what they mean here. With that plant that
okay.
For producing milk, right? How can you prove that it's probable that you will actually generate future economic benefits?
How can we tell?
Yes,
it's probable to.
Because read here, it says it's probable that future economic benefits associated with the item will flow to the entity. How do you prove that probability criteria? Let's say we bought this plant, we're going to produce the milk. The question that I'm asking is, how can you prove that it's probable that, yes, you will generate the future economic benefits? In this case, you will be able to sell the milk and generate income or revenue. How can you prove the probability? How can you be sure?
I don't know how you will prove the probability.
The question can come out in the exam, and they like it lectures. So you can't think of anything. Okay,
to prove that it will generate future income.
Yes, how can you be certain that this plant will actually generate income? I'll make an example for the sake of time.
Okay.
You are a company, you are well established, my man. You have clients, right? Some you have contracts with, some you have invoices with, you can identify already, right? But the key thing is the contracts. So if you have established contracts with these clients, you see already that plant that you bought, you can conclude to say it's probable that you will generate future economic benefits. Why? Because you have identifiable contracts with these clients. So it's probable.
Oh, okay.
You understand? It seems confusing,
yes.
but it is actually simple. You just have
no, it's not confusing. It's just I didn't know how to explain it.
Exactly. This is how you explain it. So for us to be able to be sure that we will generate future economic benefits, we must be able to identify a service level agreement or contract with these clients, because already they are binding them to say we can sell to them this milk. You agree with me? And already the past experience would have shown us, because they would have invoiced, we would have invoiced them. So already in the invoices, you can identify the amount of income that you have already generated before. You understand? So it is probable that we will generate future economic benefits in the form of revenue. You see, the cost of an item can be measured reliable. Let me ask you about that one. How can you measure the cost reliable?
How can you measure the cost of the item?
Reliable, yes. Remember, I said we bought a plant for 1,000, right? How can you measure this cost reliable? Solomon, I want you to apply your mind, because the reason why I'm doing this deliberately, the reason why I'm doing this is like I'm putting you in an exam scenario. So apply your mind. The cost of an item can be measured reliable. What can trigger you to say that this cost, I can measure it reliable? What source document?
The source document.
Yeah, I'm giving you an answer now.
The invoice charged to the customers.
Yes, the invoice. No, not the invoice charged to the customers. In this case, the invoice that you bought an asset at. Remember, because when you buy an asset, they invoice you. Am I right? So the cost there,
give you an invoice.
The cost is there, is identifiable, and it can be measured.
Okay, yes.
Reliable. You understand? In as far as the production is concerned, in this case, it's a simple example because you bought an asset where they invoice you. But what in the circumstance where you are producing this plant, meaning that it hasn't yet become productive, but you are producing this plant, meaning that you are still building the plant. You are making it ready to be used. In that case, how can you measure this cost?
We measure it at cost price.
No. How can you remember what this thing is saying?
Are we measuring the plant that we bought, right?
Okay, let me read this thing to you again. It says the cost of an item can be measured reliable. By reliable, it means that that cost, you are able to observe it and you can be able to measure it reliable. In this case, it's not an invoice where you bought the plant. In that case, the invoice, the cost is identifiable from the invoice where you can measure it reliable. In this case, what I said is that you are still building a plant, right, from scratch.
Yes. Oh, we're building the plant.
Yes, we are building a plant, right?
So it's the cost that incurred into building the plant.
Yes, the cost that is incurred in building the plant. Definitely, Simon. That's the answer that I'm looking for. And what are those costs? I'm taking you back to Menek. What are those costs that we are talking about?
The cost will be your labor.
Yes, these are the things you need to measure.
It will be your labor.
Yes. It will be labor. It will be what else?
It will be if you're using other, maybe equipment.
Yeah.
I think you can capitalize depreciation.
100%. You see? What else? Material. Am I right?
Material.
So this is what they mean by that. When they say the cost of an item can be measured reliable, they mean when you're building this plant, right? Once you have finished it and you're now in the position to recognize it in your books, can you measure this cost reliable? Yes, because why? Because already you have timesheet for the laborers who are building the plant, who are billing every month, right? What else do you have? You have invoices for materials where you are buying them from. Am I right?
Yes.
What else is there under a thing? Are any other additional costs that you have incurred? Maybe before you build a plant, you incurred some cost in terms of clearing the land. I mean, paying those people who were driving those excavators and all that. You have invoices for that. So all those costs that you have incurred, you can measure them reliable. So the standard, basically, that's what it means. It means Solomon. You understand?
Yes,
so I'm just clarifying it for you so that you get an understanding of what exactly they mean when they say the cost. Because for you to recognize an asset, you need to be able to tell that it is probable that future economic benefits associated with an item will flow to the entity. I've explained that to you. The cost of an item can be measured reliably. So in an exam position, in fact, these kind of questions, you get them when they say to you, Solomon, please advise management whether we can be this item of we can recognize this plant as an asset. The way you're gonna structure your answer, number one, you're gonna apply the definition of an asset based on what I said. You remember the summary that I did for you. A resource controlled by an entity as a result of past event from which future economic benefits are gonna flow. So you're gonna explain line by line whether are all those things met. If all those things are met, you move on to the next step, which is the probability criterion, meaning that you're going to discuss this probability criterion, then you're going to discuss also the cost, whether it can be measured reliably. Then based on that, you're going to discuss further things. I don't want to dwell further. I think when that lecture comes, I'll explain. But it was just for me to make you understand this. So,
okay, no problem.
They are saying this recognition principle shall be applied to all costs at the time they are incurred. Both incurred initially to acquire or construct an item of property, plant, and equipment, and incurred subsequently after recognition to add to or replace part of or service it, right? So I think we can move on. You understand this part, based on my explanation, right? Can we move on to the next one? Yeah.
Yes,
so the initial cost now. The initial cost, they are saying, Some items, remember, Simon, just to remind you, we're still in recognition of property, plant, and equipment. Ne?
Yes.
We haven't yet moved on to measurement. We're still under recognition. So
Okay,
in an exam scenario, when they ask you a question to say, please advise management whether we can recognize this item of property, plant, and equipment as an asset. This is what I want to see. This is what the lecturer is expecting you to discuss. Starting with the definition of an asset, then moving on to this criterion, then moving on to the initial cost and all that. You see how you structure your answer, right? So
yes.
Some items of property, plant, and equipment might be these initial costs. Ne? Some items of property, plant, and equipment might be necessary to acquire for safety or environmental reasons. Ne? Although they do not directly increase the future economic benefits, they might be inevitable to obtain future economic benefits from other assets, and therefore should be recognized as an asset. In this case, what do they mean here? This is basically, you will see when you discuss IS36, ne? This is a case generation,
Yes.
right? So they are saying, although they do not directly increase the future economic benefits, they might be inevitably to obtain future economic benefits from other assets, and therefore should be recognized as an asset. Let me make a simple example for you. What do they mean here? Ne? Let's say we have a company, me and yourself, Solomon. Ne? This company, we basically, it's a trucking business. Ne? We buy trucks. Those trucks transport milk, ne? Because we are producing milk. Ne? But in addition to that, we have offices where we have laptops, ne? Right? We have desks. Ne? This sentence here, that's what they mean. The desks and the laptops, they might not directly contributing to the generating of future economic benefits, but they are somehow helping the business to generate future economic benefits. You agree with me?
Okay, yes.
Yeah, but the trucks itself, they are the ones who are helping to generate future income because they are transporting the milk. You see? For example, the example for you here, they say that, for example, water cleaning station might be necessary in order to proceed with some chemical processes within the chemical manufacturer. Remember, the chemical manufacturer is selling chemicals. Ne? So this water cleaning station might be necessary in order to proceed with some chemical processes within chemical manufacturing. But what generates the revenue in this case is not the water cleaning station, actually. It is chemicals. But the water cleaning station is assisting the plant to be able to produce chemicals so that the chemicals can be sold. You understand, ne?
Yes.
Yeah. So, in that case, those items also must be recognized as an asset. That's what they mean. Yeah. So, subsequent costs, day-to-day servicing of the item shall be recognized in profit or loss as incurred, because they just maintain, not enhance, items' capacity to bring future economic benefits. I must make an example for you. Ne? If I have a car, ne? This car, I'm using it, let's say, to deliver milk. In fact, let's just say a bag, ne? I'm using it to deliver milk. Ne? If I'm taking that bag to Toyota for a service, ne? I'm incurring the cost. You agree with me? Will I capitalize those costs?
The cost of maintaining the buggy?
No. When I take it, yes, of maintaining, meaning that I'm taking it to Toyota for Toyota to service it so that it can run again, right? For the expense that I've incurred at Toyota, where I paid Toyota to service the car, I'm asking you a question. Can I capitalize those expenses?
No, you can't capitalize on them.
Why?
It's not enhancing the product. It's just maintaining it.
Yes, it's not enhancing the vehicle, but it's just maintaining it on a day-to-day basis because it has to run. Now, I have another example. The same bug. All tires are finished. I need to replace them. Can I capitalize them?
No.
Why?
I don't think so.
Why? Well, from my side,
I don't think the tires are major. Okay, I'm actually confused. I will say.
Yeah. Okay.
I will say yes, Ashley.
Yeah.
If the tires are finished.
Yeah.
If the tires are finished, I'll say yes because those tires can't do anything to the vehicle, so the new ones will help the vehicle.
100%. I would say to you, ne? I will put it this way. I would say number one, I will assess whether these tires are significant, right? Number two, I will assess whether these tires, because remember, this vehicle without the tires, it's not gonna go.
Yes.
You see? So I will check the motor, the vehicle value versus what is the total value of the vehicle versus what are the cost of the tires. If they're insignificant for me, I'll expense them. Ne? But if they are significant, I will definitely capitalize them. Ne? That's my perspective. Ne? I will make another example with the aircraft. Ne? An aircraft, I'm replacing the whole interior, right? An aircraft, I'm basically replacing. You see an aircraft, ne? I'm replacing the whole interior. Ne? I'm replacing the whole interior. Similarly, I'll capitalize the cost of the interior because for me it's significant because without the interior, I can't transport what do you call the passengers. You see?
Yes.
Yeah, so it's basically it's just analyzing it. In fact, the next example I see talks about the aircraft. They are saying, however, some parts of the item of property, plant, and equipment might require replacement at regular intervals. For example, aircraft interiors. So that you can capitalize because the cost might be significant. You see, by significant I mean I don't know. Different entities might use their own in terms of significance, but I'm just saying, just to be, I mean more than 50%. To me, it's significant, and that thing might have its own useful life. You see, the interior might have its own useful life. You see, similarly with the tires might have their own useful life as compared to the whole car. You see. In such case, an entity derecognizes carrying amount of older part and recognizes the cost of the new part into the carrying amount of the item. The same applies to measure inspection for fault, overhauling, and similar items. So yeah, basically when you replace those parts, you expense the old ones and then you just capitalize the new ones. What I've just done here, you through the recognition. So the recognition, these are the things you need to look at. So number one, you need to look at if let's say question, what you need to discuss here is the definition of an asset, right? What is an asset? This is in terms of IS1. You're taking notes, ne? In terms of IS1,
yes, I'm taking notes.
This is where you're gonna get all the definition for liabilities, the assets, and all that. Ne? Discuss first the definition. Apply all those criteria in the definition and see whether they meet the definition of an asset. Then from there, first you discuss. Remember, the question is, can you recognize this property, plant, and equipment as an asset? Then you discuss the definition. From the definition, you move on to the probability criterion and the measurability of the cost. From then you move on, you discuss the initial cost, the cost, and the subsequent cost. Yeah? Then the measurement, all those things you need to take into account. Ne? So now what we've just discussed now is the recognition, ne? The measurement part. Let's go to the measurement. So are you comfortable with the recognition?
Yeah, I just wanted to ask something. It's not really relevant. Okay. Yeah, so let's say for instance, you can't determine the value of that part of the asset that you have to de-recognize because you're replacing it. What do you do then?
No, but it's impossible. You know why I'm saying it's impossible? I'll tell you why.
Like okay, let's go back to the vehicle.
Yeah.
With the tires.
Mm-hmm.
If the tires are worn out, that means they have no value anymore.
Yes, they have no value. The value is zero because remember, if you are depreciating them, let's say over 5 years, at the end of 5 years, they won't have a value. It's zero. So in that case, when you derecognize them, you are derecognizing them at zero value.
Okay.
You understand?
Yes, yes, yes.
Yeah. So I don't think you'll have a situation where you can't determine the cost. Similarly with aircraft, when you replace the old interior, previously in your balance sheet, you would have shown how much, in terms of your notes, you would have shown a breakdown, how much is your interior is worth. So by that time, when you're derecognizing it, already you know what's the carrying amount. You see, of the old interior.
Yes.
So what you're going to derecognize is the old carrying amount. So you'll never have a situation where I think, that is my personal opinion, I might be wrong, but I don't think you'll have a situation where you want to derecognize an asset, but you don't know what is the value. Because already in your books, you would have recorded the asset. And from recording the asset, you would have known at year end, what is the carrying amount for that asset. You understand? So already it's identifiable. You can see what was the remaining carrying amount as at year end. So you did recognize that the remaining carrying amount. Depending obviously whether you're getting proceeds, and then you start calculating profit and loss. You see? So are you comfortable now with recognition? Eh? Can I move on to measurement?
Yes, you can.
Now we are in measurement. Ne? Measurement, let me just go there. Initial measurement. Ne? So initial measurement, what IS 16 says is that an item of property, plant, and equipment that qualifies for recognition as an asset. Remember there, up there, you already decided to say that, yes, this asset actually qualifies as a recognition as an asset, right? So now you must measure. Ne? An item of property, plant, and equipment that qualifies for recognition as an asset shall be measured at its cost. That's what they're saying. I'll make a typical example. You remember that plant that we bought? Obviously, maybe let's say using an invoice. Obviously, the cost is identifiable from the invoice, so you can measure it based on that invoice. You know exactly how much is the cost. Obviously, if the entity is registered for VAT, you just record it net of VAT. If the entity is not registered for VAT, it means you can't claim the VAT back, then capitalize the VAT portion as well. You understand? Ne?
Yes.
Yeah, so now with the plant that we're producing, that we're building, in that case, the cost would be the cost of labor, the cost of material, the cost of overhead, right? This is all those costs, you're gonna add them up, then you're gonna recognize the total cost of that plant. So this is how you're gonna measure it at that cost initially. You see?
Yes.
So the cost of an item of property, plant, and equipment comprises, they are telling you here in terms of IS 16, they are saying its purchase price. I've made an example with an invoice, or in this case, if you didn't purchase it, you are producing it, the cost of labor, material, and overhead. Its purchase price, including import duties. If you have imported the item from elsewhere, in this case, the machinery that is specialized, you imported it, let's say from Germany or UK, they will charge you import duties in South Africa, SARS. So those import duties, you capitalize them. They're part of the cost of an asset. That's what they mean. Non-refundable purchase taxes. In this case, I'm talking about VAT. Because VAT, if let's say you are not a registered VAT vendor, you won't claim the VAT that you paid in purchasing the plant. You're not going to claim it back from SARS. You see? After deducting trade discounts and rebates, if there were any trade discounts and rebates, so basically you take all those, you take the purchase price, you add the import duties, non-refundable purchase taxes, then you deduct the trade discounts and rebates. So in your exam question, if you see trade discounts and rebates, you subtract them from the cost of an asset. Then the net
Okay.
you recognize as an asset. You see? Any cost directly attributable to bringing the asset to the location and condition necessary to it should be capable of operating in the manner intended by management. Example of these costs are cost of site preparation. You remember we've discussed all these things. Cost of site preparation, professional fees if you're paying for lawyers, I don't know, for title deeds and all that, you capitalize those. Initial delivery and handling, delivery cost and handling, you capitalize that. Installation and assembly. Ne? And what is important, Solomon, ne, is that you need to understand these things because lecturers like bringing these things in the exam. You see?
Yes.
So when they bring these things in the exam, they will test you whether you will know which cost you're gonna actually capitalize. You get it wrong, and then you are not getting the marks. So based on IS16, go on IS16, read these things, make sure you understand, because they will bring them. They will say entity Y bought this asset for so much, he incurred these costs, so or they will even include cost of site preparation, professional fees, all of those things. So based on your knowledge of IS16, you'll know that no, I'm not supposed to capitalize trade discounts. I'm not supposed to capitalize rebates. I must subtract them. VAT, is this entity registered for VAT? If it is registered for VAT, I must add VAT. If they imported this asset from abroad, I must add import duties, you see? Then you'll get the cost of an asset. And for that, you're getting marks, you see? The initial estimate of cost of dismantling and removing the item and restoring the site on which it is located. Ne? Right, this one, you remember we had an example earlier when we were discussing deferred tax, ne? Where we had a provision for landfill site. Ne?
Yes.
The provision for landfill site, normally, it will relate to, I'll make a typical example with municipalities. Ne? Normally what happens with municipalities is that they will have a dumping site. Ne? The garbage that they collect from the community, ne? They dump it to a landfill site. Ne? And then what will happen is that they will get the expert to come and calculate what is the cost they will incur in 20 years' time to rehabilitate the land. Ne? Then the total cost that you would have gotten, they will come up with a discount rate. Ne? Then they will discount that to present value. Ne? Then when they discount that to present value, they will come up with the cost. They will come up with the present value. But that present value, you need to account for it in your financial statements. Ne? How do you account for it? You debit an asset. So you debit an asset, ne? Then you credit the liability. The liability, why I'm saying you credit liability, because it's the provision for landfill site, liability.
Yes.
So the debit leg, which is the cost, this is what they mean here. The initial estimate of the cost of dismantling and removing the item and restoring the site on which it is located. So they are saying those costs, you capitalize them as well. So meaning that those costs are actually an asset. You understand?
Yes.
So those are, if those costs are related to the plant and equipment, you must capitalize them on the plant and equipment. That's what they mean. You understand? Ne?
Yes, I do.
And every year, these costs will change. Obviously, when they change due to the change in percentage or inflation, you continuously capitalize them on the asset. The cost of an item of property, plant, and equipment is the cash price at the recognition stage. Yeah? So obviously, that one, you know it, because when you buy an asset or when you build it, the cash price will be, and when you buy an asset, the cash price will be on the invoice. Yeah? If a payment is deferred beyond normal credit terms, the difference between the cash price equivalent and the total payment is recognized as interest over the period of credit, unless such interest is capitalized in accordance with IS23. IS23 is borrowing cost. You know? So they are saying the discounting factor, which is the interest, when they calculate the interest, that interest, it will be, they are saying if payment is deferred beyond normal credit terms, the difference between the cash price equivalent and the total payment is recognized as interest, and it will be an interest expense, unless it is capitalized in terms of the borrowing cost standard, IS23, when you're building an asset. Because when you're building an asset, you might borrow money where you need to discount If an asset is acquired in exchange for another non-monetary asset, non-monetary asset in this case, they mean if an asset is acquired in exchange for another non-monetary asset, the cost will be measured at the fair value unless, you understand what they mean by non-monetary asset? I don't have to explain that to you, right?
No.
Yeah. So for example, what are they saying here? They are saying if an asset is acquired in exchange for another non-monetary asset, the cost will be measured at the fair value unless. So meaning that they are saying if you acquire an asset in exchange for another non-monetary asset, you must measure that asset at the fair value unless the exchange transaction lacks commercial substance. I've put this in brackets. This is not in IS 16, but I've just put it in brackets to explain what do they mean by commercial substance in IS 16. Commercial substance, they are saying when there is a commercial substance, which is when there is a change in cash flow resulting from the transaction, the parties should recognize a gain or loss on the exchange. If there is no commercial substance, record the acquired asset at the book value given up in the exchange, or the fair value of neither the asset received nor the asset given up is reliably measurable. If the acquired item is not measured at fair value, its cost is measured at the carrying amount of the asset given up. This is just your, Solomon, just go through it. If you don't understand it, let me know. I'll explain to you.
Okay.
Are you with me? Yeah, so basically
Yes,
what I've just taken you through now is the initial measurement. So what I was explaining here is initially, how do you measure the asset? Once you have recognized it, how do you measure it? So they are explaining it to you that there's different cost elements that you need to take into account to measure the asset. So you must know for the exam purposes, know all those cost elements. And they are there in IS 16, they are listed there. Now, subsequent measurement. Subsequent measurement is when you have recognized the asset, right? You have initially measured the asset. So now the asset is sitting in your balance sheet. Now you need to know, how do I subsequently measure the asset? You understand? Remember, we still under measurement. We haven't yet moved on to, what's the next topic here? We haven't yet moved on to what is this one? Let me go up there. We haven't yet moved on to impairment and all that. We are at measurement.
Yes.
So let's go there. That's the initial measurement. Subsequent measurement. They are saying an entity may choose two accounting models for its property, plant, and equipment. They are saying cost model. An entity shall carry an asset at its cost less any accumulated depreciation and any accumulated impairment losses. So the cost model, basically, you have a cost, right? So every year you depreciate an asset, and then every year the depreciation accumulates. So you'll have an accumulated depreciation. So when you take the cost minus the accumulated depreciation, you'll get what is called a depreciable, a carrying amount. You see? So this is the cost model that you'll be following. When you have a revaluation model, an entity shall carry an asset at a revalued amount. Revalued amount is at its fair value at the date of the revaluation, less any subsequent accumulated depreciation and subsequent accumulated impairment losses. In this case, you have an asset which has got initial cost, but every year you measure it in terms of the fair value, right? So now, obviously, that will change from the initial cost, but at the same time, depreciating it over the years, you see? So that's the difference between the two models. So in the exam situation, you need to know where you are. Are you in the cost model or are you in the revaluation model? And this, Solomon, will make sense to you when we start doing questions. For now, it's because it's theory, it's still trying to grasp it. But when we start making examples, that's where you're going to understand what do they mean by the cost model What do they mean by the revaluation model? Remember, don't forget, we're still going to go through examples, or questions. So that's why you're going to grasp the concept. For now, it's just for you to understand the theory behind. You see, an entity shall revalue its assets with sufficient regularity, so that the carrying amount does not differ materially from its fair value at the end of the repeating period. If an item of property, plant, and equipment is revalued, the entire class of property, plant, and equipment to which that asset belongs to shall be revalued. So when you revalue, they are basically saying that an entity shall revalue its assets with sufficient regularity, so that the carrying amount, so the carrying amount shouldn't be much different to its fair value. That's what they are basically trying to explain to you. So then basically they are saying the change of assets carrying amount as a result of revaluation shall be treated in the following way. Ne? They are saying an increase in revaluation must be recognized in other comprehensive income heading revaluation surplus, right? They are saying profit or loss if versus previously revaluation decrease of the same value. They are saying the decrease must be recognized. First, it must hit the decrease first must hit the revaluation surplus. Ne? Then the difference, if there's any more decrease, must hit the profit and loss. That's what they are basically saying. You see, other comprehensive income, if it reduces previously recognized revaluation surplus, heading revaluation surplus. You see, so that's what they mean. But you'll understand these things when we do examples. Ne? Right, we're still under measurement. Remember what you have discussed. We've discussed the subsequent measurement, right? Where I've explained to you basically the two models, the revaluation model and the cost model. And then I've explained to you this part here, the increase and the decrease. Now, also, we have what we call depreciation, which we are familiar with. Am I right? This is still under. Yes. So every year, when you buy a plant, a property, plant, and equipment, you must depreciate it. And the reason why you are depreciating it is because of wear and tear. You see, because you can't have a vehicle that you bought this year and you are driving it to Pretoria every year, let's say for 1 year. Ne? Then the following year, you're still telling me that the cost of buying this vehicle is still the same. No ways. It will, over time, it will depreciate. So you need to provide for that, because the value every year it goes down. So you need to reduce it up until such time that the value has depleted. You see, depreciation is defined as the systematic allocation of the depreciable amount of an asset over its useful life. The item of property, plant, and equipment are usually depreciated in order to maintain matching principle. As they are in operation for more than 1 year, they assist in producing the revenues in more than 1 year, and therefore their costs shall be spread among those years in order to match the revenue they help to produce. Does that make sense? Ne?
Yes, it does.
Yeah. When dealing with the depreciation, please do have 3 basic things in your mind. So when dealing with depreciation, I know depreciation sounds simple for you because it's just a matter of calculation and all that, but just have 3 basic things in your mind. Ne? Just know that before you calculate depreciation, you must know the depreciable amount. Ne? And then the depreciable amount is simply how much you are going to depreciate. It is the cost of an asset and other amount substituted for cost less its residual value. You see? So you take the carrying amount, you minus the residual value, right? Sorry, I forgot to include the definition of a residual value because it's not in the standard, but I will discuss it in the next lecture, né? So that you get an understanding. Okay. Yeah. Depreciation period. You need to know the depreciable amount, and then you need to know the depreciation period. Depreciation period is simply how long you are going to depreciate, and it is basically assets useful life. That is it. Useful life is the period over which an asset is expected to be available for use by an entity. For the number of production or similar units expected to be obtained from the asset by an entity. So it can be twofold. It can be what we call a number of periods, right, that you're going to use the asset, or the number of production or similar units expected to be obtained or produced from using the plant over the remaining useful life, you see. So in terms of IAS 16, IFRS 16 lists several factors that shall be considered when establishing items useful life. So when you establish an item useful life, you must consider the following: expected usage of the item, right? The expected physical wear and tear, technical or commercial obsolescence of the item, and the legal or other limits on the use of the asset. So these things are crucial for you to determine the useful life of an asset. The useful life and assets residual value input to depreciable amount shall be reviewed at least at the end of each financial year. This is what IAS 16 Solomon is saying. It's saying every year you need to review useful life and assets residual value, right? And the reason for you to do that when you review, because circumstances changes every year. So the useful life of an asset might change due to impairment, you know. So that's why you need to, or due to damage, which might not result in impairment, but at the end of the day, you might actually change the useful life. The residual value as well, it might change due to the fact that it's linked to also maybe market values. So market values of items, they change every year, you see. So so you need to always every year assess these things. And the selling prices of these items, they change every year. So you need to always assess them every year to make sure there was no any changes. And to be honest, management must be able to provide evidence of these reviews. The reason why I'm saying that is because you can get an audit question, right? And then they just ask you to give procedures that you will perform to make sure that management actually reviewed the useful life and assess residual values. But I'm going to leave that topic for another day. Normally, when I discuss my question, I always like to integrate. I know I'm discussing accounting, but just to help you to understand not only accounting, but also in as far as auditing is concerned. There's another example to finish with this lecture. I'm going to take you through, and then take that example, and then I'm going to make it just a quick example so that you think also of the auditing process of what you have discussed. Because the integration, because what I've learned is that lectures like integration. They'll ask you an accounting question. Subsequently to that, once you have answered that question, then they throw you with auditing. So in that example, I want to change your mind to be in a form of being integrated in terms of discussing or dealing with questions. So when you deal with the accounting question, also think about the consequences when it comes to tax. Think about the consequences when it comes to auditing. Don't just think about accounting. You understand? So, but we'll leave. Yes. I'll leave that later. I'll make just a quick example so that I'll show you just a quick example of what I mean. And then they're saying if there is a change in the expectation comparing to previous estimates, then change shall be accounted for as a change in an accounting estimate in line with IAS 8. No restatement of previous period. So the change in useful life and residual value, they are basically saying it's a change in estimate. So you don't prospectively adjust, meaning you don't go back to prior years and adjust prior years. You retrospectively, sorry, I'm getting the words wrong. I'm saying with change in estimate, you prospectively adjust, meaning that you adjust the current period, right? But you don't adjust the prior period, meaning you don't retrospectively adjust. So that's a change in estimate. You'll see maybe we will probably going through IAS 8, or we're supposed to, because already I see, as Mr. Pofolo said, the other work plan has been approved. We're still going to do IAS 8. So you'll see what I mean by prospectively adjusting and retrospectively adjusting. So the change in useful life and the change in residual value, you basically prospectively adjust, because it's a change in estimate.
Yes.
So what I've done here, I've done the summary of the depreciation. So I'm saying to you, you need to know how much. So basically how much, I mean cost minus residual value, right? And then you need to know how long, period versus number of units is what you've been discussing, right? And then you need to know in what manner the depreciable method, meaning that the cost model or the what we call the revaluation model. So that's it. Once you know that under measurement, you sort it, right? So Solomon, basically for me, that is it for measurement. So once you know all of these things, you'll be fine. You'll never struggle with anything in as far as property plant is concerned. And then impairment, we're not going to go in detail because we're still going to go through impairment when we do discuss IS36. You see, it's one of the topics that we're going to have as a lecture. So here, IS16 refers to another standard, IS36 impairment of assets, that prescribes rules for reviewing the carrying amount of an asset, determining the recoverable amount in impairment losses, impairment loss, recognizing and reversing impairment loss or more. IS16 states that compensation from third parties for items of property, plant, and equipment that were impaired, lost, or given up shall be included in profit or loss when the compensation becomes receivable, right? So in this case, I will make an example. Let's say we have we had floods, and then our vehicles was damaged, totally damaged, where it has to be impaired. And then we claim from our insurance pays us money. What is saying this IS16 is saying that money, the proceeds that you received from the insurance company, obviously you will calculate profit and loss because you need to take the proceeds that you received from the insurance, provided that the proceeds exceeds the carrying amount, you will have made a profit. But if the proceeds is less than the carrying amount, you will have made a loss. So that proceeds, you recognize it as a revenue. That's basically what they are saying. For example, a claim for compensation of damage on insured property from insurance company is recognized for profit or loss when insurance company accepts claim, closes the case and agrees to compensate, or after whatever procedure is agreed in the insurance contract. You see? So basically that's what they're saying. So don't worry about impairment. I've included it here so that it forms part of what you need to understand under PPE. But remember this, we leave it to the next lecture because it's a long topic that we still need to go through and discuss. Recognition. Okay. Right? So now that you have recognized an asset, right? You have measured the asset, right? There will be a time where somewhere, somehow you need to de-recognize an asset, right? So you need to know, for example, it says IS16 says, IS16 prescribes that the carrying amount of an item of property, plant, and equipment shall be de-recognized on disposal, or when no future economic benefits are expected from its use or disposal. So that is when you will actually dispose of an asset. It says, IS16 says, prescribe that the carrying amount of an item of property, plant, and equipment shall be de-recognized on disposal, right? Or when no future economic benefits are expected from its use or disposal, right? When will you have a situation where there is no future economic benefits that are expected from its use or disposal? When would you have that kind of a situation?
When there's a situation to de-recognize the assets.
Yeah. No, I'm saying, well, to de-recognize, yes, you'll have that situation. It's simple when you have to dispose of it because you are selling it, right? But I'm saying, when would you have a situation where when there is no future economic benefits are expected from its use of an asset? When will you have that situation?
It's when the asset has broken down and is not repairable.
Yes. So the option you have is to write off, right?
Yes.
Yeah, so you are no longer basically going to use it for anything, right? So they are saying when you de-recognize an asset, the gain not classified as revenue or loss arising from the derecognition of an item of property, plant, and equipment shall be included in the profit or loss when the item is derecognized. The gain or loss from the derecognition is calculated as the net disposal proceeds. Normally what happens is that you will have proceeds, right? But from those proceeds, you might incur some cost that you need to net off from the proceeds. So that's what they mean by net disposal. Usually income from sale of item, less the carrying amount of the item. So net proceeds or proceeds minus the carrying amount will give you a profit or a loss. You see, that's what they mean. So I've done a nice summary for you here so that you know when you derecognize an asset, when to derecognize PPE on disposal, when you sell it, right? No future economic benefits. In that case, we've discussed it. Then you calculate your gain or loss. And then let me just wrap this thing. And then net disposal proceeds minus carrying amount will give you the what I call a gain or a loss, right? Right. Now that I'm done, I'm finished, Solomon. Did this help? Did this summary help? When I was taking you through all these concepts, yes. Do you understand or you have questions? You can ask me questions. Don't worry about it.
No, I don't have questions.
From my side,
I don't have questions so far.
But you understood, ne?
Yes, I did understand, yes.
Right. Remember, still, when you go through the material again, if you're not sure, just reserve the question for me for next week. Ne? And then before we start a class, maybe before we start a topic, let's just discuss those questions. Ne? Right. Okay. I want to do a quick example for you when it comes to auditing. Ne? You remember that plant that we bought? Ne? We bought a plant. Yes, this is going to be a quick example. Maybe it will take us 5 minutes or 10 minutes, and then we'll be done. Ne? You remember that plant that we bought? Ne? For 1,000, right? So now for accounting, we have discussed, you understand everything, the deferred tax and all that. Ne? But now let's put it into perspective when it comes to auditing. Ne? Let's say I say to you, a company X bought this plant for so much, and then I want you to design procedures for me to audit the purchase of the plant, right? So obviously, in your asset books, you'll have what I call additions. Ne? Am I right?
Yes.
Because you have what I call in your asset register, additions of 1,000. Ne? So in a nutshell, what I'm trying to say here, you're going to be auditing these additions. You understand?
Yes. Yes.
And then how do you do that, Solomon? Ne? For you to understand auditing, my man, you will never get an auditing question correctly if you don't understand the source documents. I always tell people thing, and people sometimes they don't listen to me. Even where I was working, guys, for you to understand auditing, you need to understand the source documents behind, right? So I'll take you through the source documents. Ne? So the first document that you'll have when you purchase this plant, you agree with me when I'm saying there's going to be a need for you to buy the plant? Ne?
Yes.
So when there is a need for you to buy the plant, you have a document called requisition. Ne?
Yes.
So let's say a person wants this plant. There will be a need for you to buy the plant. Need for you to buy, for you. Or meaning that someone from the organization must actually fill in the requisition, and someone from the organization must actually approve the requisition. You agree with me? And by approval, yes, I mean there has to be a signature on the requisition form to say that we've given you guys permission to buy the asset. You understand? So that's an approval, and it's probably at high level, maybe the manager in that division. Ne? So when there is a requisition issued and is being approved, there will be a document called a code. You agree with me?
Yes.
Because you need to source this asset. the suppliers. Ne? Normally, it will be sourcing it from, say, 3 suppliers. Ne? Simon, please take this example, ne? Write it down, ne? Because it will help you when it comes to auditing.
Right? Oh, I already know.
All right. So now you have a code, ne? And what else do you have? After the code, you'll have the purchase.
You also need a purchase order.
Yes, you'll have a purchase order. After the purchase order, you'll have
an invoice.
No, you see, you say you know, and you are wrong. See?
Purchase contract order, or invoice?
Purchase order? A delivery note.
A contract or invoice?
No.
Oh, a delivery note, yes.
Yeah, remember a contract, it fits in here, basically. You can fit in here under purchase order. Ne? Delivery note. This is a key document, boss. This one here, it's a key document, the delivery note, because that's when you're going to know whether the risk and rewards of ownership have passed. You see? And then that's when you're going to know whether you can recognize an asset or not. Because once you get the delivery note you sign, you are basically accepting that you have received the asset and you are happy with that asset. And then you are giving the supplier the permission to then invoice you. Am I right? Invoice. Right? Then from the invoice, where are we going to go?
From the invoice.
These are all source documents, né? That you need to mention when you write an audit question. So these are all source documents, because trainees, I mean, guys, more especially in the exam, you write procedures, but your procedures are vague. You don't. The lecturer doesn't understand what you are basically talking about, because you are not mentioning source documents or anything. So what is the last step? After
isn't it the creditor statement?
That one, remember, those are ledgers. I'm talking about the source documents, the bank statement. Am I right? Or the bank?
Oh, it's bank statement.
Yeah, because you have to pay. Yeah? Right, let's leave it here. So now if I had to say to you, audit these editions for me, how are you going to go about it? Ne? You're going to start by saying, I'm going to obtain an edition listing. Ne? And then what are you going to do with that edition listing? Because obviously they would have bought so many assets during the year. So you're going to obtain a listing of editions, ne, from the client. Ne? And what are you going to do? You're going to cast and cross-cast the listing, right? You're going to get a total. Ne? And with that total, the intention for you to cast and cross-cast is for you to make sure that that total agrees to the one which is listed on the asset register. You see? Then you would have somehow proven that these assets are complete, and also the accuracy thereof. Because when you cast and cast, you are basically making sure that the listing is accurate. You see? Then after having done that, you're going to select a sample of items from the listing. You see? You're going to select a sample of items from the editions listing. Depending on the firm's methodology, you're going to select a few items there. Then what are you going to do? You're going to request for support documents. You see?
Yes.
These are procedures that I'm telling you, boss. You're going to select a sample of items for editions. Then you're going to request support documents for those items. Then what are you going to do with those source documents? You're going to inspect the requisition form to confirm that the requisition was actually approved by the relevant official or the manager, right? You're going to inspect the code to confirm that the codes were obtained from 3 suppliers and the price was quoted on the code, right? And then the purchase order, you're also going to inspect to make sure that the asset was actually purchased and all that, right? So you see, you're inspecting a document, you see, or a contract. Then you go inspect the delivery note to make sure that the asset was delivered, right? But in addition to inspecting the delivery note, you're going to match the quantities on the delivery note to the ones which are listed on the purchase order, to the ones which are listed on the code, and even on the requisition form. Why are you doing that? because you want to make sure that the items agree, and then meaning that the accuracy of the items, they agree, you see. Because if on the delivery note you have 2 items, but on the order, on the code, on the requisition form, we've actually ordered 1 item, you see you have an issue, meaning that 1 item must be returned back, you see. So you are basically proving accuracy. You're going to inspect the invoice. What are you going to do in an invoice? You're going to inspect the invoice date to make sure that the transaction had occurred in the correct accounting period. In that case, you testing cutoff. But not only that, you're going to reperform the calculation on the invoice to make sure that it is correct on the invoice. And you're going to agree to the one is on the GL. You see? So what are you doing by doing that? You are making sure that it's accurate. You see? And then what are you going to do? You're going to agree the VAT amount to the VAT control account to make sure, and you're also going to reperform the calculation of the VAT to make sure that it agrees to the one on the VAT control account. Because why are you doing that? You are doing that because you want to make sure that everything is accurately recorded in the general ledger. You see? You're going to trace the amount on the invoice to the bank statement to make sure that the payment was made. You see? So when you inspect these documents, the requisition, the code, the purchase order, you are basically proving whether the transaction for additions has occurred. You see? That's the occurrence assertion. But in addition, you are proving the accuracy, the completeness, and all that. You understand? You follow it?
As a source document, wouldn't you also request for a creditor statement?
No, definitely.
Like,
you're gonna
for instance, if you haven't paid for the asset,
come again. If you haven't,
wouldn't the creditor also send you a statement of how much you owing? Wouldn't also that be reliable?
No. Definitely, I agree with you. You're right, né? But don't lose direction. Remember, what are you testing? You are testing additions. What you are saying, you are testing the payable now. You see?
Oh, yes.
You are testing the payable. Because when you start talking about creditor statement, when you start talking about the what we call, what else? The remittances and all that. Now we are testing the payable, which is related to the asset that you bought. If you haven't bought, if you haven't paid year end. You see? So I was telling you, how do you audit the additions? First, each and every question that you identify what are the source documents. Then from there, it's going to be easy for you to design procedures. Because where you guys are missing it in auditing is when you don't identify what are the source documents behind. You see? Because once you know the source documents, it's easy for you to then design procedures to address all the assertions that you need to address. So this is just an additional material that I had to go through with you guys. I know I'm assigned to do accounting, but I thought it will be very helpful for you guys to also integrate what we've just done in as far as accounting is concerned, but also integrate with auditing so that you don't, because these things go hand in hand. You know? You don't just do accounting, you also do auditing. So this is how, but also if you want me guys to do procedures, proper procedures, I can do that for you. But it was just to summarize it for you. So that don't think about only accounting, but also think about if this asset I had to, I'm buying this asset, how will I then audit it? You see? You understand? So,
Yes.
I think that's it for today.